So one thing that we've learned over the last year and a half, we had our 9th anniversary called benchmarking on April 1st. And there's something that fermented over the last 18 months, which has really culminated in a view for the industry that is so critical. In the boardroom of the club, the finance committee room, we're very focused on the income statement. We bring an eye towards trying to, quote unquote, manage expenses, save money, believing the income statement is the financial driver of a club. What we've come to realize now, and this chart proves it, what you see here is on the blue line, you see the net operating margin. So it's the operating result divided by the operating revenue. You can see the median is 1%. So that says that the club in the middle, this is for all clubs across the country, the club in the middle, the operating bottom line was 1% of the total revenue. So if you just take clubs with golf, the average club's got $7.5 million in revenue. So that would be a $75,000 operating surplus. And you can see if you look at the 25th percentile and the 75th, basically -2 and +4%, just rounding a bit, -3 to +3% covers at least half the clubs. And the point is that operating bottom line is a break-even proposition. As we know, 80% or more of the clubs on this webinar today do not use depreciation as an expense on the operating ledger or consider it when they set their dues, so that the operating ledger is set to break even, excluding depreciation expense. And as such, the money that results from the income statement is not significant, especially in relation to the line above, which is the gold line. And what that shows is the total capital income as a percentage of the operating revenue. So back to the median, where that club had a 1% operating surplus. At the median, the total capital income is 12% of the operating revenue. So it's 12 times the amount of the operating result. The income statement is not the financial driver of a club. This is the epiphany that we've had. The income statement is there as the vehicle to deliver the services and amenities to members during the year. It doesn't produce a financial outcome. It's not designed to. It's designed to break even, as we know. And the reason for that is it's where we derive our services and amenities. So we essentially consume the finances that are involved in the income statement. We consume them as members in clubs, enjoying the services and amenities that we have. Whereas the capital income is intended to persist over time. And if we go to the next slide, please, Eric. Eric's controlling the slide since he's going to be doing most of the webinar. When you look at the balance sheet, this is a key portion of our recent epiphany in this regard. If you think about the balance sheet, and if you think that the income statement or the concept makes sense, that the income statement is there to break even and it's the vehicle for delivering services and amenities, the only thing that persists over time financially is your balance sheet. In the balance sheet, when you look at a club, the average club, 80% of the assets end up on one single line item on the balance sheet, and that is the net book value, or the after depreciated value of property, plant, and equipment. So that includes depreciation expense, because it's after the depreciation expense and the total depreciation expense over time. So the point is 80% of the assets, which is the money a club has, the value, the financial wealth a club has, end up on that one line item. That's what persists over time financially in a club, is the physical property, plant, and equipment that you have, or we have. So on the next slide, just to dig into this a little bit, this is, directly linking to capital strategies and capital planning. If you think about the scenario of what happens to your net property, plant, and equipment, if you had a club that was built 50 years ago and it cost $3 million to build, and the club never reinvested a penny in any of that physical plant, the balance sheet in terms of its physical assets would look like this. The gross PP&E would be $3 million. The accumulated depreciation will be $3 million. Everything will be fully depreciated. And the net, the after depreciated expense net value of the property, plant, and equipment would be 0. If you did a ratio of the net to gross, the ratio would be 0%. On the other end of the spectrum, if a club opens yesterday and it costs $30 million to build, more today than in the past, obviously, the gross PP&E is $30 million. The accumulated depreciation 0. We haven't operated yet. We haven't had any depreciation. And the net is 30. Therefore, in that club, the net to gross ratio would be 100%. Every single club in the country is going to fall somewhere between that old dilapidated club on the left and the brand new club that opened yesterday on the right. And on the next slide, Eric, please. What we see is we've got on this curve 450 clubs, and we have the net to gross ratio for 450 clubs. And you can see on the left, it goes from about 5%. On the right, it goes to 100%. There's actually a couple of the clubs that have an anomaly. And we put them in just for full disclosure, but they actually don't depreciate physical property, plant, and equipment. That's a whole nother story. But just focus on the, let's say, the 10% to the 80% ratio. This is a real club, Club XYZ. Club XYZ's ratio is 38%. The median for the industry is 48. So the further to the left you go, or we go on that ratio, then the more depleted the assets and the physical plant are at that club. And the further to the right we go, the more up-to-date and fresh those assets are. There's another angle to look at it in the lower right corner here. Some of the physical plant has an aesthetic view. So if you look at furniture, fixtures, and equipment, for instance, this is a real club. The furniture and fixtures in that club were at a net to gross ratio of 14%, so they're pretty depleted, versus the buildings and improvements, and that includes parking lots and whatnot, we're at 46. So this club had a 38% ratio, but the investment hadn't been in the, let's say, the furniture and fixtures, the things that a member or prospective member might see. So that's another angle just to keep in the back of our mind as we go through this. But the point here is, this is the only thing that persists financially over time. Obviously, it's critical. And now Eric's going to speak to how we plan, because what we've seen in the industry is we don't focus on the future capital needs and resources because we're hamstrung focusing on the income statement, which isn't going to deliver a financial outcome anyway. So Eric's going to take us through the view of how to plan and strategize future capital needs and resources.
Okay, Ray, thank you very much, and good morning and good afternoon to everyone joining us today. It's really nice to see so many joining us on this topic. I'm joining you from Southern California today, and as Ray mentioned, I'm a recent addition to the team at Club Benchmarking, and as you can see with my background, I come from the perspective of being a club manager, so it's really a nice contrast to having all of the great minds at Club Benchmarking on the accounting and financial side, and just taking it from a little bit of a different perspective. But having lived this stuff and gone through these capital improvement projects and trying to figure out how everything was going to work together was really what helped shape my future in trying to develop some of these programs. So a little bit of what we're going to be covering today is we're going to talk about some capital benchmarks and some statistics that I think that everybody, whether you're a director, whether you're a manager or a controller, should know. We're going to talk about two topics, what we call playing a capital offense and playing a capital defense. And we'll get into these and you'll see how they work together. We're going to talk about the mindset of private club capital budgeting, and we're going to talk about using modeling to be able to plan out your next 10 years of capital for your club. So the first thing that we'd like to mention is we think that there's a little bit of a disconnect between what club members in particular think is going to happen with their future expenses, especially as it relates to capital when they join the club, and what the reality is. And so the first question I'd like to ask everyone to think about is, do members, board members, and managers really understand the true capital costs of the club? In other words, do you understand everything from the irrigation systems to the kitchen to the HVAC systems, everything that is considered a capital asset? Does everyone really understand what those true costs are, because we all know that we have stake in them and we all need to be able to plan for them adequately. So in terms of the club leader's role, we like to think of the club leader's role in a couple of ways. Number one is to raise awareness, increasing the understanding of current funding levels and how much is actually needed to achieve that club's mission, being able to evaluate the cost of your debt service, replacing capital assets, and future improvements, and then lastly, educating the leadership team about the options available to make sure that both the capital income and investments are aligned over time. So here's a few numbers that we'd like to throw out at all of you. With the team at Club Capital Planners and purchasing that company and having about 175 reserve studies now in our database, we've been able to look at some numbers that we think are pretty important. The 350 to 600 number is what the average 18-hole golf club has in terms of individual capital assets that will require replacement. The $8 million to $11 million is what the typical 18-hole golf club should expect to spend over the next 10 years to replace those current assets prior to their useful life's expiration. And keep in mind, this is looking forward for clubs that have actually done this process the right way and had the reserve study completed. 2 to 5 years are how often clubs tend to engage in what we would consider substantial improvement projects. We use a term called aspirational capital. So if you look at the definition of that below, these are capital investments in assets that do not currently exist, and they're meant to expand the services and amenities to keep your club relevant to both your existing and future members. So we'll use that term aspirational capital here throughout the presentation. Here's a few more fast facts. This was something that Club Benchmarking did a couple of years ago. And the median increase in private club operating revenue over the last 2 years is about 6.9%. So certainly not a shocking number there. But over that same 2 years, the median increase in private club capital income has gone up 29%. So what that tells us is that the industry as a whole is recognizing the importance of investing in capital at their clubs. The real question that we'll get into is how do they fund those investments? You can also see that 11% is now the median capital income as a percentage of annual operating revenue. So one thing that we're going to be talking about is how much should your club be investing in capital programs? And when we have what we call net available capital, and I'll show you that slide next, you can basically do three things with that net available capital. You can reduce your debt, you can focus on capital repair and replace those assets, or you can fund a capital improvement project reserve. So here's that definition of net available capital, and you can see total capital income adjusting for your operating result minus your lease payments. And you can see that the industry median is right about 12% as a percentage of your operating revenue. So if you think of your club's operating revenue, and you think of the net available capital that your club has to invest in those three things we just discussed, take a look at that percentage and where would it fall? We'd like to think that clubs should be closer to that 75th percentile if they're really truly investing, and getting closer to that 15 to 18% for the clubs that are growing and continuing to invest. So we did an interesting exercise here in the last week. We took all of our data at Club Benchmarking and we wanted to tell the story of the median size 18-hole private club and what the capital program looks like at that club. So if you look at the numbers, the median size 18-hole private club is a $6.3 million annual operating revenue. There's 403 full member equivalents. The net initiation fee is $25,000. Capital dues are $50 a month for the regular members of the club, and the attrition rate is right around 5%. So if we take that same club, we're going to look at the median capital costs at that club. So we said before that looking at all of the data that we have with all of the capital reserve study information, between $8 million and $11 million over that 10-year period, putting that right in the middle annually, that repair and replace number would be at about $950,000. And keeping in mind, we know that most clubs don't currently spend that much, but our data would suggest that if we're going to be replacing assets prior to their useful life's expiration, that should be the amount that we would look at. The aspirational capital fund of $240,000, what this is this assumes that a club is going to do an aspirational capital project about every 5 years at an amount of about $1.2 million. So the new project, whether it's a new fitness center, a new golf facility, something that's not a current asset at the club and is not currently on the club's reserve study, these are the funds that would be required to be able to fund those two projects. And the average debt reduction at a club would be about $260,000. And of course, that would be offset by an assessment amount under the income. So the average annual capital requirements at the median club is just under $1.5 million. The median capital income is we have our initiation fee income, which would be $425,000 at that median club. We have a combination of capital dues and assessments. So we would largely assume that the debt reduction amount would be offset by whatever assessment was put in place. And then we would have the capital dues line, which was that $50 a month. And those two things combined would equal about $480,000. So if we look at the annual capital revenue and the capital requirements, we're going to see a difference of about $545,000. So that's obviously a pretty staggering number for the industry when you're looking at the median club. Here's what it would look like on a 10-year capital projection schedule. So this is using our modeling program, and I know that it might be a little bit small for some of you, but you can see we start with a beginning cash balance of around $300,000, which is right about the median. We can see that our transfer fee number comes in here. We're going to assume no equity refunds. The capital dues line, we're going to see our special assessment. We're going to see our repair and replace number, our two projects of $1.2 million. And we're going to see our debt service line. So you can see that the special assessment and the debt service line both match. So that, in other words, that's going to be a debt service fee that club implied. And so the median club is going to be looking at a shortfall of about $5 million over that same 10-year period. And that's obviously something that's a big concern for the industry. If we look at this on a graph, this is essentially what we would be looking at if the club was to do nothing different and it wanted to be able to fund those capital investments. So I can't think of a director that's out there that wants to see their club's capital cash projection look like that. So one of the things that we're going to look at is why do we have the gap between projected needs and resources? And this is something that we would call a defensive capital strategy. But first and foremost, the club's focus has probably been on the income statement rather than focusing on the real financial driver of the club, which is the balance sheet and capital. The club likely does not have a professional objective third-party reserve study to identify, prioritize, and plan for those timely replacements, or if it does, it's simply not following it. And lastly, the club does not set aside capital funds for aspirational improvement projects. So this is what we would call a defensive capital strategy, and one that the natural outcome of this is going to be deferred maintenance and having to fund projects and deferred maintenance through assessments and debt. So when we look at the difference between an offensive and a defensive capital strategy, once again, if we look at the defensive approach, it's very reactive. So when you look at being resistant to new ideas from the board, they're probably going by the way the club has always done it. The loudest voice in the room will likely receive the available funds. Deferred maintenance can often become the inevitable case, and common funding methods are assessments and debt, which are reactive methods. Funding one project at a time rather than funding the actual capital plan. Lengthy, controversial, and costly funding campaigns, and of course, just kicking the can down the road and letting some future board deal with it. So when we are in this defensive mode, one of the likely outcomes is going to be member assessments. And we see lots of issues with member assessments, and some clubs can handle them better than others. But there's certainly some things that you want to consider if you are going to enter into a member assessment strategy. Number one is member dissatisfaction. When we think about member unity at a club, we want all of our members to feel great about their club. And as soon as we give them something that's controversial, we all know what can happen. but it is certainly not uncommon for many clubs to lose between 5 and 20% of their members with a large and unforeseen assessment. And this is particularly true if this unforeseen assessment is due to the fact that you're actually replacing an item that should have been planned for in the past. But when we look at our members, most of them pay their regular club bill, and we like to say that this is on autopilot. The bill comes, the bill gets paid, you don't think a whole lot about it. As soon as we give our members something to really think about in a negative way, it could reevaluate and consider the club's value proposition. They might start thinking, how many rounds of golf have I played in the last year? How much does that equate to when I look at how much I spend at the club? And we certainly don't want that to happen in our clubs. But even if they agree with the project, we can have people that are infrequent users that may now have a motivation to resign. When we're in defensive mode, debt is always going to come into play as well. And we can certainly have a lot of issues with debt crippling the club's ability to make future improvements if it's not very well thought out. If we are going to be using debt, we have to make sure that future capital replacements, aspirational improvements are able to be funded. So once again, using debt for repair and replace is very different than using debt for aspirational capital. So here's a little food for thought on debt. About 3/4 of the clubs that are out there have debt. The median number is $1.8 million for that same 18-hole golf club. We can certainly use loans to leverage large projects with assessments collected over time, but we need to make sure that those length of payments are accounted for, future repair and replace, and the aspirational projects are all accounted for. Most of the club bylaws will see if some member approval is required. And of course, we have to factor in the lengthy and often costly campaign that might be required to gain votes. And lastly, we all have to think about the rumor mill, because as soon as we start talking about debt covenants, negative pledges, or potentially encumbering the property, that certainly will happen. Now, in contrast, let's look at an offensive capital strategy. The offensive capital strategy is the proactive approach. We let the club's mission be the driver and not the other way around with an offensive capital strategy. We use zero-based budgeting not only for our operations, but for our capital budget. And we develop a capital funding philosophy that is understood. We use a reserve study, we plan for our future improvements, and we use a projection model to be able to project our capital revenue, identify the funding gaps, and evaluate options. So in terms of looking at that mindset, we like to look at the first mindset being let the mission drive the budget. And this is a great quote from the former CFO of the YWCA, which is one of the largest nonprofits. People who are in financial capacities at nonprofit organizations must understand that we budget for the mission. We don't change the mission to suit the budget. And unfortunately, we see a lot of clubs falling into that category of letting the budget take priority while the mission continues to slip. The second capital budgeting mindset we'd like to identify is using zero-based capital budgets. So one of the things we'd like to identify is what is the most important decision that comes from budgeting. We all know that if we're doing our operating budget, we're going to beat up the expenses to the extent that we can. We're going to identify trends that we need to consider. But at the end of the day, the most important decision is where to set the dues line. And if we're using incremental versus zero-based budgets, incremental would be just looking at what we did last year and putting a small percentage on top of that. Whereas zero-based, we're starting from scratch and identifying all expenses and all sources of revenue. And our operating budgets address 1 year at a time for the most part, but capital budgets really need to extend well into the future. And here are the reasons for that. Our capital expenses are going to be variable from year to year. For any of you that have done a capital reserve study, we all know that the dollar amount tends to vary and fluctuate greatly depending on the projects that need to be completed. Take, for example, the roof over your clubhouse or your irrigation system. If something of that nature is due in that particular year, you're going to see that dollar amount rise considerably, whereas other years it might be much shorter. So we can't just look at a straight line number and feel as though it's going to be something that we can count on year over year. But we also need to incorporate the next 2 to 4 improvement projects, or that aspirational capital, and knowing that over that 10-year period, those costs are also going to vary. We need to make sure that those investments and income align over time, and if we're going to use debt or an assessment strategy, we know those periods can extend out up to a 10-year period. So when we're looking at having a funding policy, I'd like to point out to you an operating funding policy versus something that's very uncommon in our industry, which is having a capital funding policy. So if we look at operations, most clubs will have a designed operations to be either break even or fairly close to that. And as Ray appropriately identified, 3% on one side, 3% on the other side. And to look at the funding policy, we're going to say the operating expenses, which is the byproduct of the cost of providing those services and amenities that our members expect. We're going to identify those expenses. We're going to look at them. We're going to see if they're appropriate. We're going to vet them appropriately. But then we're going to look at the non-dues revenues that we expect, whether it's food and beverage revenue, guest fee revenue, and then we're going to have a gap in between that. And that's where we set the dues to be able to achieve that break-even result. So if we look at a capital funding policy and we were to take the same mindset, we're going to look at what it's designed to do, which is to ensure that our physical plant reflects the level of goods and services that are defined in our club's mission. So the capital needs, which would be the timely repair and replace of existing assets, also looking at our aspirational capital and the service of any existing debt. The capital income would be the net initiation fees, capital dues, our membership growth line, and debt and assessments, and those strategies would be set to align with the capital needs over time. And this would be an example of a capital funding policy. At Club Benchmarking, we're actually just starting to breach this subject a little bit more in detail. And I think over the next couple of weeks, we may have something to put out to the industry as a true example. But this is just an example that we came up with quickly, which says something to the effect of the club would segregate the ledgers. We would use a capital reserve study to determine repair and replace expenditures. The capital dues line would be set annually to cover those expenditures. Improvement projects would be vetted and prioritized by a committee. All new member transfer fees might be used to fund that improvement account, and the improvements must be approved by the board when the improvement account collects enough funds to cover the entire project. Now, obviously, this is not a policy that's going to resonate at every single club, because some clubs collect much more in initiation fees, some clubs collect more in capital dues. But the one thing that we like to be able to say, if we have a correlation between sponsoring members and improvements, in other words, if the transfer fees are used to fund the capital improvement account, we could have a message to the members such as what you see below. Congratulations to you, the members, who sponsored 40 new regular members this year. Thanks to your involvement and support, I'm happy to announce that we will begin construction on a new state-of-the-art golf and fitness facility next month. In other words, you, the members, came in and sponsored this many new members for us, and because of that sponsorship and the initiation fees that came of it, we are now going to put a new capital improvement project in for your use. This brings us to what we call capital strategies modeling. And the modeling platform purpose is to be able to identify the needed capital repair and replace expenditures, factoring in existing debt service, any operating shortfalls, and future improvement projects or aspirational capital. It's also designed to calculate and project out any operating profits or losses, the membership trend line, transfer fees, and capital dues, to identify the gaps between needs and funding levels, and to develop strategies to adequately fund those needs. So the first thing that we would look at in using our modeling platform and our modeling system, or what we would call an offensive capital strategy, is the capital reserve study. Our last Fast Facts webinar, it's taken me 3 or 4 times on that one. This one went into detail on the capital reserve study with Paul Mueller. So we will send out a link to that if you did not get a chance to view that webinar. But essentially, it's a professional study that's used to identify and assess the remaining useful life of all of the physical assets to determine funds that are required to repair and replace your current assets. We also want to take a look at the aspirational capital improvements that your club would like to complete. These would be the projects that are going to enhance the membership experience, keep the club relevant and attractive to the future members. So here are a few examples: a new casual bar and lounge, construction of a fitness center and spa, expansion of the driving range, or a new swing analysis center. Notice that we're not using any of the current assets, such as the replacement of an irrigation system, to use as what we call aspirational capital. And once again, this is a look at our 10-year capital projection platform. And we can see the required capital, which would be the repair and replace number. We can see the aspirational capital, which would be the improvements. And we can see the total capital investment over that 10-year time frame. So looking at sources of capital, we can see that the following would be considered capital sources. An operating surplus, or the opposite of that would be the deficit that would drain capital. Our net initiation fees, so this would be the total initiation fee minus any selling member's equity. We have our capital dues line. We have membership growth, assessments, bank loans, and of course, sale of land. So looking at other items that might impact our capital balances, of course, we can look at beginning cash balances. We can look at any existing debt service, any installment payments that might be due, established cash balances that we want to keep. So we might have a $500,000 floor, which is pretty common, that we want to keep. And of course, looking at restricted funds all need to be factored in when using modeling. So once again, looking at that same 10 years for the median club, the capital funds that this club is generating over that 10-year total is about a little less than $8.5 million. The capital requirements are almost $14 million. So we can see that we have a gap here of about $5.3 million. So the real question then begs, how do we close that gap? And what we want to look at if we're going to start to develop strategies is we need to look at what the capital levers are that we can pull to be able to generate additional capital without resorting to assessments, debt, or sale of land. And those four levers are operating profits, net transfer fees, capital dues, and membership growth. These four levers are the things that the club can decide and make conscious decisions to change to generate more capital. And the club should be able to develop strategies for each one of these levers. And when we look at the levers, one of the things that we like to do is benchmark each of those levers based on your clubs of your stature. Whether it's the operating margin, the transfer fees, we would look at what we would consider to be the benchmark, and we would look at if your club has opportunity for any one of those levers. And if we did, we would identify what getting to that benchmark would mean for your club over a 1-year, 5-year, and 10-year time frame. The first capital lever is operating gains and losses. And on average, most clubs work to break even. In other words, you're consuming the income statement through your services and programming and not using operating gains as a financial driver of the club. But what that essentially means is that we need to ensure that operating dues are set to the level which are going to cover all of the operating expenses after your non-dues revenues. Several clubs use a true-up strategy. This can work, and I've seen it work effectively for many clubs to ensure that they're not draining from capital if there is an operating loss towards the end of the year. And on the flip side, any surplus in operations are going to add to capital income. The second capital lever is our net initiation fee, which is our total initiation fee minus selling members' equity or other refundable amount. In other words, this is the amount that contributes to your club's capital fund. But the net initiation fee sends a very strong message about the club's history, membership, service levels, and quality of the facilities and offerings. And I'll tell you just a very quick story that just happened to me yesterday. I was speaking to a club and we were looking at their total assets, and we were combining the total assets with what they're charging with the initiation fee. And the initiation fee was incredibly low. It was around $3,000, yet the club had $24 million in assets. And so the question that I asked them is that an appropriate initiation fee for your club? But the healthy clubs that we see in the industry keep their initiation fees high and the dues stable, while struggling clubs tend to reduce the initiation fees and raise dues excessively. And in most cases, not for the much larger clubs, but in most, the net initiation fees are inconsistent and they're insufficient to fund the entirety of the club's capital needs. But the club can always consider things such as installment payments, non-refundable equity. I'm sure most of you that are on the call today have considered non-refundable equity at some point. But what we've seen is that the majority of the industry is moving towards more of a non-refundable equity policy. Our third capital lever is capital dues. And capital dues are a stable and consistent mean of being able to fund depreciation. And all current and future members will pay capital dues as opposed to an assessment, which is largely levied to current members of the club. About 2/3 of private clubs now have capital dues. And a few things to consider with capital dues is, does your capital dues line cover the repair and replace of your capital assets long term? If it doesn't, what is the purpose of your capital dues line? And I found that several clubs really don't understand why they have a capital dues line. They know that they want to generate additional capital, but there's really no philosophy behind having that dues line itself. When was the last time you raised your capital dues? We see that operating expenses and capital expenses rise every year, yet for the most part, only operating dues increase each year to keep up, whether it's the 3 or 4%. So the real question is how far have you fallen behind? Capital dues versus food and beverage minimums. One area that we've seen clubs start to move towards or away from is, instead of having a food and beverage minimum, converting a portion of that minimum into a capital dues line and eliminating the minimum in its entirety. But what we find is that the food and beverage income is not the real driver of the club's finances, yet the capital dues line absolutely is. And should transfer fees be counted on to contribute to funding depreciation? In some cases, yes, and others, no. One of the things with modeling that we're able to do is use sensitivity analysis. So when we're looking at capital dues and initiation fee strategies, using modeling allows you to go in and quote unquote plug and play with various scenarios. So we might ask the question to say, what would happen if we raised capital dues $10 a year over the next 5 years? Or what if we were to raise it $100 in year 1? What about initiation fees? What if we were to try to raise initiation fees yet give our members 3 equal installment payments to be able to pay it off? But modeling allows you to use those strategies and see what the actual effect of your 10-year capital cash flow is going to be. And we can see with our model here that we've created one capital strategy for the same club with only capital dues. And what we were able to come up with, if we were only to increase the capital dues, is that we would need a $100 increase to our regulars, a $50 increase to the other categories in our first year, and following that we would need $20 in 10 years annually thereafter. But you can see that we're able to get the club to a net positive and growing with that strategy. Now, that is a lot for our members to take on in capital dues, but using our modeling platform, we can tell our members, if we only wanted to use capital dues as a strategy, here's what we would be looking at. Here's what it would look like on our chart. So we can see the blue line is where the club is going if it changes nothing, and we want to fund our capital investments. And our first strategy looking at capital dues only. Our fourth capital lever is membership growth. And we look at this as the great multiplier because membership growth contributes to both the transfer fee line and the capital dues line. In some cases, our bylaws and membership caps may need to be reevaluated. And when we work with clubs that are completely full in their membership, one of the questions that we ask is, when was that provision put into your bylaws, and does it apply to today? So if we're looking at the same club with 403 full member equivalents, $25,000 in the initiation fee, and a $50 monthly capital dues line with the attrition of 5%, here's the difference between a 3% net annual growth in membership versus flat growth. So in other words, if a club is currently bringing in 15 new members a year and 15 are leaving, that would be considered flat growth. But if we net 3% more, here would be the 1, 5, and 10-year difference in capital cash with both the transfer fee line and the capital dues line. And we can see at the 10-year mark, that's almost $2 million in additional capital cash for getting to 3%. So some things to consider for membership is, do we need to reevaluate our membership caps and processes? Do we want to have a membership marketing committee versus a typical membership committee that their job is just to vet candidates? Do we have a professional membership director who is able to go out and fill the pipeline? And demonstrating to your membership the importance of growth. So in other words, we could tell our members if we're not going to grow our membership. In other words, if membership growth is off the table, we can demonstrate how higher dues and fees have to be on it. Looking at things such as preview programs and various member incentive programs, and I know that all of you have been through many education sessions on those topics. Once again, looking at sensitivity analysis, we're able to play with the various strategy options for membership. What if we were able to bring in 5 more members in this category? Or what if we were to grow our social membership or our junior membership? What would that do for us? And in looking at developing a strategy for membership growth, if we simply took the same club and didn't do anything else except for having to grow the membership, what would we have to grow it to in order to get our capital balance to meet the needs? And for this particular club, we would have to have a net membership increase of 11%, which is a very hefty number. And here's the chart showing now a second strategy case with growing the membership. And of course, looking at assessments and debt strategies, we can absolutely do those, but we want to make sure that we do them cautiously, because these are alternatives to adjusting the capital levers. So in other words, if we've tried to strategize with the capital levers and we simply cannot get there, we may be too far behind to avoid using some of these strategies. But we do want to make sure that we factor in potential membership attrition if we are going to have an assessment, or we need to forecast our debt service over the entirety of the service life. We also need to ensure that the future improvements and replacements are not compromised. And we need to forecast all of the available options with current membership levels, dues, fees, and membership growth. And we have to factor in the political firestorm that comes along with some of these strategies. We also have to ask ourselves, how many times can we go to the well with our members with an assessment and debt as a strategy to fund capital projects? So once again, using sensitivity analysis with modeling, we can use assessments and debt strategies by being able to plug and play with various interest rates, various numbers of months that we can offer our members to pay off their installments, and we can see what that does to our overall capital cash. And in looking at a third strategy, along with modeling, we were able to take a portion of membership growth, a portion of capital dues, and be able to use a loan to be able to handle some short-term capital needs, to be able to forecast a third strategy that said, instead of growing our membership by 11%, let's grow it by 3%, and let's take a portion of the capital dues and not have to do an upfront fee of $100, but simply do a $25 annual increase, and use that loan to be able to handle those short-term cash needs, and be able to come out at, we started at a $5 million loss after the 10-year period, and we were able to turn that into a $3 million plus gain. And if we look at a third strategy on our chart, we can certainly see how that would look in terms of strategy for your club to consider. And once again, using strategies at every club is going to be different. For some clubs, they may have much more opportunity in membership growth, while others may look more towards capital dues lines, maybe increases in initiation fees. We don't find that operating net has a major effect on the majority of clubs, but in some cases it certainly might. So being able to use modeling will help your club be able to identify which strategies are appropriate for your club to consider. And at the end of the day, getting your club leadership to elect a strategy that's appropriate for your club and being able to focus on ensuring that strategy's success. So once again, to summarize, we look at the median 18-hole golf club, which underfunds capital requirements by approximately, actually a little bit more than $500,000 annually. The defensive capital approach is the reactive approach. Common outcomes are assessments and debt to fund deferred maintenance without adequate planning for the aspirational capital. And an offensive capital approach is the proactive approach and uses the following best practices. The capital reserve study by an objective third-party professional, which determines the needs to repair and replace our assets, and using a capital model that will incorporate that data as well as aspirational capital projects to be able to project your income, identify the gaps between required and available funds, and provide sensitivity analysis with the available capital levers to identify our solutions. With that, I would like to thank you for your time and for being on this webinar today. I'd like to turn it back over to Terry for a few final wrap-ups and to see what questions that we have.
Thanks, Eric. You can see here on the screen for Evergreen chapter members, Florida chapter members, and Wisconsin Badger chapter members, if you email those code words specific to your chapter to the people listed there, they will submit for education credit. If you have any questions, you can post them. There's a toolbar on the right-hand side of your screen, and you can type your questions there. We had one earlier that I noticed that was asking to explain what a true-up strategy is.
Sure. A true-up strategy, and it's a great question, is also widely known as the 13th month of dues. And in a private club operation, we all know that there are certain decisions that get made that the manager does not have complete control over. And so in some of these cases, what we do is instead of making a decision that's going to be negatively impacting our membership in terms of whether it's raising the price of food and beverage, or if we're seeing a trend line come in that we didn't get as much banquet revenue as we thought we were going to get, rather than trying to go in and correct that, because it's really not in our mission to go out and get additional banquet revenue, we would simply do an additional dues amount at the end of the year to be able to fund whatever we came in short on our operations, so that we're not draining that amount from our capital account.
Okay, I have another one. Are these parameters generally applicable to boating clubs as well?
Yes and no. I would say that the parameters for what we would consider the median 18-hole golf club would change. And it might be an interesting strategy, and Ray, maybe you could weigh in a little bit, because you've done a lot of work with yacht clubs.
We're definitely happy to work with, whether it's a yacht club or a city club, to actually, characterize the, median club like that as well. And we also clearly, especially if you're already involved in service, we will work directly with you with your club. We don't have to take medians. We can make sure that we have characterized your own specific club properly, because we have every one of the metrics that Eric's looked at, we've looked at, reside on the platform, so we could benchmark your club where you are today, and then begin the process of, to Eric's whole webinar here, planning out the future.
Okay, we have a couple people that asked you to explain transfer fees.
Sure. So a transfer fee would be the same as what we would consider a net initiation fee. So if you look at whatever amount that the member pays to essentially join your club, we would look at the difference between that amount and whatever amount you would have to pay any selling member's equity with that same transaction. If you have no selling members' equity, then it would simply just be the initiation fee. So it's the amount that actually contributes to your capital account, if that makes sense.
Okay. Someone has asked whether maybe you can explain how this works. Could Club Benchmarking make the 10-year capital cash forecast model spreadsheet available for clubs to use?
It's a service that we've begun to offer, but we're happy to discuss the parameters of that service in terms of what you get and what the price cost is with anyone. But obviously the whole point of this in this webinar, and I'm looking at how many people still are on it. It's amazing. I know we've hit a chord here because, it's a what is it, a Thursday afternoon now, pretty much everywhere where everyone is. This is the topic. This is the most important topic. This is the focus, the strategic focus. This is where clubs need to be. And if we've made that concept clear, and if people are interested in how to get there, we can help you get there. We're really devoted to this now across the industry. Obviously, we understand the income statement as well. But the success, the future success, the outcome, the positive outcome for any one club is directly related to what we've talked about in the last 55 minutes.
Right. Okay. We had one person ask about the estimated cost to have a survey done of the property, which is our capital reserve study service, and we will have someone reach out to you after the webinar on that one. How does non-refundable equity differ from initiation fees?
It's the same thing. If it's not refundable, it's really just an initiation fee, and that's, as Eric said earlier, that's where the industry's heading. If a member writes a check for $25,000 to join a club, non-refundable would mean they don't get any of that back when they exit the club.
Okay. I think that looks like that's it on questions. You can see on the screen there that Eric's email address is there and the phone number for our Boston office is there. So if you have questions or you'd like to continue the discussion, certainly feel free to reach out.
All right. Well, on that note, I'd like to thank everybody for attending today. And once again, as Terry said, if there's anything that we can do to assist your club in achieving capital strategies and working on your long-range capital plan, please send me an email, and we'd be very happy to have a conversation with you about how that would work. And on behalf of Ray and the team in the Boston office and Terry in St. Louis, thank you very much for joining us today.
Bye-bye.